Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
Let's go out there. It's October 18th. I'm Frank Curtis, the Wall Street Unplugged, so we break down headlines and tell you what's really moving these markets. Glad to be back. Busy week. I'm back for a meeting in Cambridge, Maryland. Had no idea there was a Cambridge, Maryland until last week. What a beautiful place. Right along the coastline. Stayed at a really nice Hyatt, which is right at the water. Beautiful. And that's where Agora, who's a big player in our industry, held its Publishers Roundtable. This is basically a meeting among the top publishers at Agora, along with a few outside ones that they invite, to discuss the state of the industry and new ideas. You compete against higher interest rates, right? You get 5% for free. Some people feel like they don't want newsletters anymore, unless you're really good at your job and you're providing exceptional value. And going to this meeting was real special for me. I mean, I know a lot of these people, the other publishers. It's a tightly knit industry. It's something like Ford, GM, Tesla, Rivian, major auto manufacturers meeting in a closed door session. I think it was about 35 people or so. We built a lot of great relationships, learned a ton from those guys. Just brilliant in terms of marketing. And I mean, these are firms that are generating, they've generated at the peak well over 100 million in sales, some over 200 million in sales. They're like a little dot, right, compared to them. But to be invited to that meeting, that closed door session, it was really cool. It was really cool. And they had a lot of respect for me, which I really appreciated. I have a lot of respect for them. But just learning from those guys and talking to them and future partnerships and things like that, it really creates value for all of us and especially the customers, right? Because that's what you want. You want to put out good information in front of these people. And I hope they learned a lot from me. They were looking for new ideas, and I told them, hey, this idea is outside the box. Every time I explain it to people, they're like, I don't know. I don't get it. And I understand that. Maybe I have to do a better job of explaining it. And I try to break it down, and you guys know, right? Educate them about tokenization, what we did here. As many of their companies, divisions of Agora, are much larger than ours, and they could raise a lot of money by tokenizing their business. And it makes sense. And we're huge in this industry where if other companies want to grow, they have to raise money. So our list is different. Everybody has, their own lists. You have, Starbucks has their list, Walmart has their list, whatever company has their list. We have lists of investors that are looking to invest in really cool ideas. And that's why we were able to raise money. Plus, I know their customers, their subscribers want an equity stake in their business. Who doesn't? You can provide a perk with anyone that comes in. It's accredited investors. A year later, you could trade on a T0 or something like that, and you're seeing this build up. Tokenization really starting to take off. Just, guys, do a Google search. Just do a Google search. Put tokenization and hit news in Google. Just look at what's come out in the past 4 months. I mean, you'd be blown away by the stories. This thing years ago, early, I don't think it would have been early if we didn't have COVID and then we had SPACs and all this other stuff that competed. Now we realize SPACs are shit. They're garbage. But this trend makes a lot of sense. You can provide perks for people that come in. Those accredited investors, maybe they get that top-tier membership for 3 years, but it's a good way to really have your best customers participate. And that's what everybody wants. Even at your job, what do you want? How do you keep employees? How do you make them happy? You know what? They want to participate in the growth of the business. Make that possible. Make that possible. And this is a way to do it. It's also much better to have a tokenized structure to be part of one of the biggest trends I believe that any of us are going to see in our lifetime. You're like, Frank, you're talking your book. I'm not talking my book. Let's go over the numbers. And you look at every bank is launching their own blockchain right now to tokenize most of their trillions in assets. It makes sense from every point of view. If you have an illiquid asset of commercial real estate, you sell off 20% of it. Say if it's $100 million, I give this example a lot. You sell off $20 million. Now you get a $20 million check. You could invest in more commercial real estate. You could do anything you want with it. But now it's liquid. You have investors who would own real estate, commercial real estate, for the first time ever. You can provide a nice yield on it because you're probably generating nice income, 7-8%, which is pretty much, you don't want to use the word guaranteed in my business. You get the SEC knocking on the door. But, in the right areas, assuming your commercial real estate isn't, filled with, 5 horrible retailers or whatever it is. And now a year later, you could trade this, and the person who owns the real estate valued at $100 million, it's going to be valued more because now it's seen as a publicly traded security or a private security that trades publicly, to use the right term, because the SEC won't get off his ass and just regulate this shit already. Now think about that. The average business trades at what? 19 times earnings in the S&P 500? That's a publicly traded company. That's why you go public. Get that high valuation, cash into the business, you grow faster. If you look at it private, they trade maybe 3 times earnings. But if you tokenize, you're going to trade 6-7 times earnings. So even though you're selling off some of the equity and you still control it, right? It's not like you're giving away more than 51%. You're getting a $20 million check on a $100 million business. That $100 million business in that commercial real estate is now going to be worth a lot more than that. This is why it makes sense. I've covered trends all my life. And the ones that are successful and the ones that make sense are the ones that make it easy, much easier. If it's a technology for all consumers, something that's costs less, and something that benefits all parties. I mean, you can think about it. Why does Airbnb work? Why does Uber work? Why has the metaverse not taken off yet? Because you have to wear the big masks, which are changing. Zuckerberg's coming out with the glasses that I sampled for 5 years at Consumer Electronics Show, which never ever work. It's just funny. It's like, oh, we don't have this working right now. They don't. If he gets this right, that's it. Because people are going to wear regular glasses. It makes it a lot easier. That's why EVs, it's not easy to charge a car. There's markets for both of those, but we're talking about things that make sense that are going to be disruptive. So if you're looking at this trend, I'm saying it's going to be the biggest trend in anyone's lifetime. There's over $16 trillion in liquid assets that can become tokenized. That includes real estate, bonds, corporation. Reason why New York Stock Exchange sees this as the future in trading on exchanges. That's why Larry Fink, at the dominating ETF industry, BlackRock, said this is the next biggest trend we will see. Franklin Templeton, CEO Jenny Johnson, this is at CNBC's Delivering Alpha conference last month. The tokenization is securitization on steroids. They're all in. Franklin Templeton, $1.5 trillion in assets. And to put this in perspective, everyone believes AI is the trend. You got to get in. AI is it's $120 billion. That's what it is. That's the market size right now. Well, the market cap of tokenized assets is already close to $200 billion, and you never even heard of it yet. Most people don't know this. You have because, some of you participated. I talk about tokenization. That's what we did for our business. Again, we trade on T0, and I think that volume is going to increase. Liquidity is going to increase a lot more. You can see a lot more issues. But you look at AI in 2030, by most estimates, it's supposed to be around $500, $600 billion business. That's by 2030. So tokenization is 25x AI, or the size of AI. Believe me, I cover trends. You guys know. Consumer Electronics Show. You guys watch the videos, do live stuff. I mean, you get into trends well before anybody else, sometimes a lot sooner than everybody else. This is the biggest thing anyone has ever saw. And it's coming, and it's here. So get involved. But anyway, as a financial publisher, I'd rather be in the middle of the tokenization trend with that structure, or labeled as a tokenized company, than be labeled as a financial publisher, which we're viewed on the same scale, I'm not kidding here, as porno and marijuana companies when it comes to credit card processors. That's a pretty big deal. And we have low barriers of entry. Anyone could start their own newsletter. Wait till you have a promotion that really works and you get it out and you generate a few $100,000 in a couple of weeks for the first time. Watch what happens. They shut you off. We were shut off for a year. $1 million for a year. They did not give us $1 million for a year, our credit card processor. We had to go through that whole entire, you know how difficult that is and how to manage a business? It's crazy. Because they're like, wait, what is this business? What's going on? How can you generate so much money? You're a startup or whatever. And that's what happened. And then, eventually it takes a while. You build and establish credibility. So we don't have that problem anymore, credit card processors. So low barriers of entry. But when you get bigger in this industry, and by bigger, just, $500,000, $1 million in sales, man, it is a nightmare. But it's also an industry many investors, including Wall Street, hate. They hate subscription-based businesses. They're lumpy, almost impossible to forecast. I mean, GAAP earnings, think about it. So when we get a new subscriber, it's a liability when they first come on your list. It's a liability. It's not going to turn into an asset until 12 months later because technically they can cancel. That's why when you look at subscription-based services, whenever they report, we don't say, we're generating revenue. It's billings. But it's a lumpy business where you could generate a lot of revenue and then a little bit of revenue. And that's why they always like, try to have an advertising model. This is with TheStreet.com. They hated the subscription business. That's why Wall Street didn't cover it. The CEO then, Tom Clark, was like, okay, they want to see us get into advertising. That's why you go to TheStreet.com. There's 5,000 freaking advertisers all over the place. It just pop up like crazy. And you're seeing it all over all these sites now. It's insane. Which I guess is all right. They're forcing you to pay $5 a month without the ads. But, there's just like 100 ads. You can't even get, and you got to click 10 times to get through a story. It's a joke. But that's what the analysts want because it's recurring revenue. It's easy to forecast. And Wall Street likes analyzing businesses that are easy to forecast because they keep their job longer. Right? That's what it's all about. So picture this idea in our industry, and you're going to see it in a lot of different industries. If you take the time to sit down and learn about it, learn about the costs, and, even with your businesses, if you guys are interested, let me know. But I can tell you the big thing is when you do this, you're going to have hundreds, if not thousands of companies doing this over the next 3 years. And you know who they're going to come to? They're going to come to me. And they are. And I spoke to the founder of one of the largest athletic companies in the world. One of the largest undeveloped lithium producers wanted to tokenize their business instead of going public. They wanted to do it this way. I can't tell you how many people reached out, and it was crazy pre-COVID when we first did this, and now we're starting to get lots of questions on it again, which means what? Which means these are the ideas that we're going to be able to invest in early, that my subscribers are going to be invested in early, and that's really freaking cool. I think that's why you guys listen to me. That's why you subscribe to our products. You want to have unique ideas. You want to have a different take on the markets. You want to have someone you could trust because you see the agenda going on. You see it. They're going to report what they want to report. The best thing is when you hear a government, and this is what we're hearing, right? Ever since Israel and Palestine, this is unbelievable. Right? That what's going on. I don't want to get deep into it. But we have government saying that they want to shut down sites because of misinformation. That usually means that they want you to follow an agenda and they don't want you to know the full story. Because everybody should know the full story. And we live in a world where learning the full story where, for me, I want to know what could provoke somebody to do what they did. I want to know that. Okay, this isn't war and it's all, this is personal. Oh my God. I called so many of my friends, but, for me to get on a podcast and talk about that, it's like, oh my God, do you support Palestine? I just want to know the story because if we know the full story, maybe we could avoid something like this in the future. And I know this dates back for hundreds of years and it's not going to change and there's strong feelings on both sides. But not being able to learn the history about it or know about it because our government, who's the king of spreading misinformation, which we learned about COVID tremendously, right? Oh, my God. What an agenda. Let us figure it out for ourselves. We're pretty smart people. I think we can identify what's bullshit and what's not. You have communities now. Someone posts something, they're like, oh, this is bullshit. This is wrong. Even you go on Twitter and they tag it and be like, okay, this isn't proven or whatever. But whenever I see a government come out and say that and say, oh, well, we're worried about TikTok or Twitter or these, constantly going after the organizations that really allow the most free speech. They say, oh, we're worried about misinformation. Really? Because when they say that, that's them saying, okay, we want you to follow an agenda. And that's why I love doing what I do. Because, you have to go there. You have to go to these places. You have to research stuff. You have to dig in. You have to find other sources, different sources. Find the real story. Because when you do find the real story, you can make a shitload of money. And that's what I've done throughout my career. And that's what I love. I love thinking something and then all of a sudden it's something totally different because I've done the research. I'm like, wow, holy cow, I had no idea. I had no idea the EPA was trying to shut down a company because they said there's rivers that go through it that's, for what is it, Northern Dynasty, shutting down one of these the large undeveloped gold and copper project because of environmental concerns where rivers run through the property and go 150 mile plus into Bristol Bay. They're going to kill sockeye salmon. And when I go there and it's in the middle of nowhere, you have to take a helicopter. I have to take 2 planes in a helicopter. There's no rivers there. There's no river. I said, are you kidding me? They're like, nope. That's the report. That's what everybody says. You'd be amazed. And that helped me generate a lot of money on that company. And also a good time when to sell it because both parties don't want to see that project developed, even though both parties have never, ever visited that site. It's incredible. This podcast, wasn't surprised when I went to this conference. They were all interested in podcasting, building communities. There's very few in our industry, in the financial newsletter industry, and they want to know how to become successful at doing it because they see our model and saying, wow, this is really, you have amazing community, amazing people. And I gave them the best advice. And I was honest with them. I said, don't do it. Don't do podcasts. Don't have your editors do podcasts because to have a really good one requires total passion. I'm all in. I love this stuff. That's what people are drawn to. I don't care if you hate something. If you don't like a certain type of music, even if it's like heavy metal. If you go to a heavy metal concert and you see those guys on stage, you're like, oh my God. I mean, this passion, they're into it. They get lost in it and people are attracted to passion. They're attracted to it. No matter what it is, you can look at things and say, wow. I mean, when people, it's the greatest thing ever to see someone, how entertaining is it to see someone who's the best at something that they do? Tiger Woods, Kobe Bryant, Michael Jordan, Tom Brady. I mean, you hate them. You hate some of these people if you don't like the teams, but you watch them because it's like perfection. It's like, oh my God. Again, that's what people are drawn to. And to have an editor and just go and say, hey, why don't you start a podcast? Which is basically they're writing probably a few newsletters. They're traveling. They should be, doing the job they're being paid to do. But you're putting more work on their plate. And it's something that you're probably not going to pay them for. And they're not going to be able to monetize it because it takes you a while to build up an audience. You can't do that overnight. So I was honest, told them, listen, most of your editors, they may give it a go, and some of them have, but they wind up giving up probably a few weeks later, a few months later. I see it all the time, and I'll help them. I mean, another podcast coming to the industry is not competition. It's not like we're all on at the 5 p.m. time slot, and you can't tape it, and I love it. I'll help you. Come on my podcast. I'll promote you. I'll help you out. And I've done that for several people in the industry, and they do it, but it's a commitment. It's difficult. And for me, I love doing this. I love telling the stories of me going out in the field and going everywhere and going on trips. I love educating investors. And I love the feedback. The emails are coming from around the world. I mean, this goes out to 100 countries now. But it's helped me generate numerous ideas. And staying ahead of the market because a lot of data that's reported is lagging. A lot of the data is lagging. Earnings are lagging. It's what happened in the last 3 months. Right? You're looking at economic data. I mean, there's a reason why they revise it 3 times every month after they report the quarterly data. And look at the jobs number. They revise it. They revise it. They revise it. They revise it lower. They revise, what is it, 7, 8 straight months, significantly revisions lower. Look at GDP. How many revisions you have there? But seeing what's going on exactly when it's happening, like the reporting of COVID that we were able to do. I mean, it's fascinating. And just to see how doctors are calling in and then doctors telling me, hey, don't mention my name. I'm like, what are you talking about? I want to mention your name. I want to give you credit. Nope, I'll get fired. What do you mean you'll get fired? You're saving lives. Nope. Holy shit, what the hell's going on? That's pretty cool. But I love the interviews and debating my guests on current topics. I never do layup interviews like Jimmy Fallon. Oh, that movie is so great. That was so awesome. Oh, you were so funny in this. No. That's why Howard Stern's great at interviewing. That's why Joe Rogan's great at interviewing. And listen to your guests and talk to them. Don't give them layups and don't conflict with them. They're coming on your show. You don't have to be an asshole to them, even if you disagree. If you disagree, I had Peter Schiff on the podcast. I disagree with a lot of stuff, Peter Schiff, but I wouldn't be like, hey, well, I wouldn't really destroy him. I mean, maybe with facts and things like that, but, I wouldn't make it that this is big argument because it doesn't benefit. I don't think the audience, it might be cool for a couple of sound bites, but, why does someone think so different from me? Let's educate ourselves and figure it out. In fact, even when I debate, I love losing debates more than winning. You know why? Because when I interview a guest, I'm prepared. I'm going to know everything about you, your methodology for picking stocks. I'm going to know your track record. Everything you wrote over the past 3 months I'm going to look at, even videos that you did. When I interviewed Jim Rogers, it's the same thing. What do you think about commodities? What do you think about this? I didn't want to do that when I interviewed Jim Rogers. I asked him questions outside the box. What country are you going to invest in? I think he was like North Korea. This is like 4 years ago. Where do you see him saying that? I don't want to ask him the same exact questions everyone else is asking him because the interview is meaningless. Although when I did interview him, which was great, he was walking on a treadmill. He was doing a lot of exercise at the time, getting in shape. And he started coughing and he couldn't catch his breath. I'm like, you okay? So I almost never edit podcasts. I don't edit anything. We just go and I give it to the guy and they put it up there. Even if there's a mistake here or there, I'll get emailed about it if, a stat's wrong or for me, I'll joke around if there's a mistake. Like, I don't care. Like I just had, one of my speakers on and went off and I'll shut it off right here. You can see on video. I'm not going to take that out. It's real. But Jim Rogers was on a treadmill. He started coughing, and he started like choking. And then we stopped for like 3-4 minutes. I said, "You all right?" He's like, "Yeah, I'm better. And then, as much as it would be really cool for my career if you died on this podcast, because it'll go everywhere, I really don't want you to die." And he was like hysterical laughing. It was cool. But when I come to these interviews, I'm going to know everything about you, even your favorite hobbies, which most people are going to list on their LinkedIn or Facebook accounts, which is easy to show these are real people. Not just about all the markets and everything, but that's an interesting conversation. You interview them 25 minutes, and most of these guys say the same thing after I interview. They're like, this is like one of the greatest interviews. I know, because I did homework, because I gave a shit. I hate when people come to my company and they want a meeting and they say, "Oh, Frank, I think I can market. I think I could do this. I think I could do that." I'm like, okay, and I'm busy. I got away the past few weeks on business, going, family and all this stuff. And they come, they're like, "Well, how many products do you have? How many products do I have?" You can't look on my fucking website and see how many products I have? Really? You can't take the time to look on my free site? You have a meeting with me. I just talked to people from Japan. We're going to be marketing our newsletter in that market, and they love us. It was great, and this is through Agora. And they said, "We think it would be a great fit. We love your material. It's awesome. It's fantastic." And man, it was incredible because they were like, "Oh, you like the Japan market now?" And I just mentioned that on a podcast like a week ago, 2 weeks ago. And I'm like, wow, they did their homework on. And I actually thanked them. I said, "You know what? Thank you for really spending the time to do the research on me." You know how a guest feels when you do that? It's awesome. So when I come prepared and someone thinks differently than me, and I have all these statistics and everything, and they're able to change my mind, which some have done. Porter was, bullish for the first half of the year. I thought it was. I interviewed him in February, I think. Cuppy was super bullish on oil in early 2021. I thought he was crazy. I'm like, no, great job. And now look how many oil stocks. Look how much we benefited in our portfolios from oil. But if you're able to do that and you're able to change my mind, I tip my hat to you. That means you did a lot of homework in order to do that. That's why I love this freaking podcast. It's awesome. It's educational, idea-generating machine. I learn something new every single day, which I hope all of you are lucky to do in your line of work. Don't be stuck at a job where it's just constant. You're getting a paycheck. Learn. There's a billion things to learn. There's so much out there. As you get older, you realize, wow, I'm not smart at all. Because there's so many brilliant people out there across so many different industries. It's fascinating. It's fascinating to learn. Ask a lot of questions. People who are great at things love to get questions. They love it. I know. I talk to everybody. They love it. Talk to them about their industry. People love talking about themselves or what they do. Have that conversation with them. "Oh, really? Well, what about this? Just talk to someone at Citibank. We're getting more assets than we ever generated. Oh, my God, they're all coming in from these mid-tier banks. Great information 2 weeks ago. They're right. From mid-tier banks who are struggling right now because having money in a mid-tier bank, you're taking on 100% risk and no upside. Chances are you're going to be okay, but why take the risk? Throw it in JP Morgan. Throw it in Wells Fargo. Why? These companies, provide benefits where there's great local housing industry and things like that, but that's not doing that well now. And now you're looking at it with interest rates really actually hurting them. But money and capital is being removed. They're in short-term treasuries. They're worried about the capital ratios they're supposed to keep. I think that's what happened in Silicon Valley. They're not allowed to merge with other mid-tier banks because our FTC and the Justice Department doesn't allow mergers anymore. Barely. You got to go through a massive process no matter what it is. I mean, Microsoft could offer to buy, I'm trying to think is the most competitive industry in the world, which is gaming, basically. And look how long that took for Activision Blizzard. But, they could offer to buy an AI company with $1 million in sales, and they'll find a way to block it and go through and concessions and all this stuff where it's, a simple process sometimes. But this is the information I get, and it works best when you have a great network of listeners that email you all the time with great information across your industries. This includes college kids to hedge fund managers, CEOs, all across the spectrum. This is where you get the ideas from. So I want to thank you for that. Really cool, and I love doing this podcast. Now, enough of the BS. Let's get to the markets real quick. Interest rates high, credit card debt surging, bank credit tightening. Actually, I have a chart of this broadcast on YouTube. This is pretty credit contractions. There's credit contractions here. I mean, look at this. Bank credit contracting tremendously. I mean, we haven't saw this during the financial crisis for a little while. That's the level we're at since 1974. And people are like, stocks are going higher. You're fine. You're okay. That's what happens when you have nonstop government spending. But now you don't have that, especially what's going on in the House. I mean, man, the Republicans are a bunch of freaking idiots. Just get together. I mean, basically, it's 9 people that are dying to get special treatment. That's what they want. Let me hold out. You need my vote. That's all it is. Politicians, right? Forget about providing aid to Israel, whatever. They don't care. I just want what I want. You really can't come together? It just shows you how terrible, how broken our political system is. It's just horrible. But now that results in what? A lot of things not getting approved, more funding not getting approved, funding Ukraine not getting approved, which, whether you think it should get approved or not, it could mean that less money going to some of the defense companies. And then you had Israel, so maybe that offset that and saying, okay, now we're going to provide weapons and, but just different things that you have to see what's going on in the political landscape. But credit contraction is here. I mean, guys, look at the chart. Seriously. Go to our YouTube page. We post all this stuff. I mean, it's insane. I mean, you have a lot of stuff. I mean, you're looking at housing market rolling over, 8% mortgage rates. So you look at all this tightening, higher interest rates, housing market, big, huge driver of GDP in the economy. Yeah, they're saying, well, supply, that's holding up prices. And it doesn't mean there's demand where people buying new homes and getting new furniture and getting new supplies and everything. So you're looking at a market that's expensive here, consider where interest rates are. However, everyone's extremely bearish right now. And so much so that if you look at the bull-bear reading, and this is the B of A, I mean, it's now at green levels, meaning more people are bearish, and when they're really overly bearish, it's a contrarian indicator, it's a time to buy, but it hasn't been at these levels since November 2022, October 2022, and the market's bounced. A lot of people predicting, a potential bounce. And here's another chart. Look at money market funds surging. I mean, look at these levels. This goes back to 2007, this chart. It's at 5.7 trillion, right? And that's about as this month, October. In May 2020, it hit this level. In January 09, right? I mean, it didn't hit this level, but that's when it peaked before it came down. So you're looking at, we're at 5.7 trillion. It peaked at around 4.7 trillion during COVID, and that's May. But if you're looking at 19, 18, we're at $2.5 trillion. Now it's $5.7 trillion. But if you notice this chart, every time it spiked to these levels, I mean, you're looking at a massive spike. When was it? January 09. When was January 09? Pretty close to the bottom. May 20, close to the bottom. Now October, are we close to a bottom where stock's going to run higher? Listen, it's a different environment. We didn't have super high interest rates, which is why, it provides a better alternative. It's not apples to apples comparison. But people look at the money market fund assets and people going more into safety. And again, January 09, they went to safety. They weren't generating anything. May 20, they weren't generating anything. Now you go to safety. I don't know if you say, well, I'm going to go treasuries, money market funds to be safe. It's not being safe. It's being smart. You're generating 5% plus. But still, some people look at this and say, well, that's a contrarian indicator. We could see a pop in the markets coming. I don't know. Maybe they're right. Maybe they're wrong. Long term, just into 2024, credit contracting, interest rates relatively high. The Fed doesn't seem like they're pausing yet. But we could see a pop, which, ironically, I think every analyst on CNBC is now predicting. Oh, we're going to see a run into, some believe we can hit a new high this year, which, I think is insane if we would do that. I mean, it would be incredibly overvalued. But, we could see short-term pop because when that pendulum swings and everything's really bearish, it's been, really bad past few weeks. You might see that. But now you throw in earnings season, which is upon us. It's a big deal. And not really Q3, right? So this is Q3, which we're reporting, and earnings are relatively flat around there. But next quarter, you guys should know this. Earnings are expected to rise 8% in Q4. 8%. Remember, we declined year over year, 3 straight quarters. Now we're into this quarter, could be 4 straight quarters. While the market has been surging up to the past month, which is remarkable. Usually earnings drive stock prices. Now it's government spending drives stock prices because it's not earnings. But it's key because these companies better be raising estimates. And you're not really seeing that. Most of the reporting is saying, hey, the consumer is getting weaker. United just lowered estimates, but said the CEO actually implied this, that the low-cost airlines are dead. Higher oil, labor costs are crushing them, killing them. So they're going to have to raise prices, and they're going to have to raise prices to what? To the levels that you've seen at American, Delta, United. And you know what? The experience on those are much, much better than experience on, you get what you pay for with discount airlines. I know. I go to Dominican usually once a year with my family. And, you take discount airlines from where we are. We have to go to Miami, and then it's usually a discount airline or, that fly directly. Sometimes not really flies directly to Jacksonville these days, especially on the West Coast. After anything like, west of Texas is 2 flights. But you see the drop off. And they charge you all these fees anyway, all these fees. I mean, you shake the hand, you go to the bathroom, it's a fee. It's like a fee for everything. And now they have to raise prices. So I was joking when people say they're going to start discount airline, but look at JetBlue. Spirit just warned. I mean, they're saying it's going to impact them significantly. To say that they're dead, this isn't a trend. To say they're in a lot of trouble. Yet PG report good numbers. CEO's on there, pat himself on the back, and this is what we did with it. Yeah, it's good, and the numbers were good because they raised prices. They're a company that was able to raise prices. Is that really, really good? Are they seeing more demand? Are they seeing volume growth? No, not seeing volume growth. Retail sales, you're not seeing volume growth. You're seeing sales explode because things are higher. So we're still seeing inflation in the market, which is at 4%, guys. 4% inflation. What does that mean? We've never seen inflation this high since 1991 if you take out last year. That's how high we're still on inflation. We're a lot lower, and it feels better. We're still way, way, way above 2%. So these earnings actually good? Are they quality? I don't know. I'm not sure we'll see 8% growth, but if we do, and this is really ironic, if we see 8% growth, it's not going to come from the growth sectors like tech, information services, and semis. You know what's going to come from? It's going to come from the banks, and it's going to come from oil. Large cap banks, their earnings are surging, oil surging, and that's not good. If you look at bank earnings for the large guys, the guys that make a fortune, over the mid-tier are struggling. Even some of the other large ones are struggling, but the top 4 dominate the industry, are getting bigger and bigger and bigger. But they generate high earnings. Why? Because interest rates have surged, which is horrible for the consumer. Look at oil companies. Their earnings are surging because energy prices are going through the roof. Again, something that's not good for the consumer. So be careful what you wish for. Oh, we're going to see 9% growth in earnings. It's going to come from the two worst industries in terms of consumer and how they spend. So we see that massive earnings growth. It's not going to be such a good thing. We're going to say S&P earnings grew 8%. Yeah, mostly from the banks, mostly from oil. And that's horrible for consumers. Okay, I'm going to break this down further in tomorrow's Wall Street Unplugged Premium podcast, including what banks you should be investing in, what oil companies we like. We're also going to share new pick, which is not so new. We actually closed out for a very, very nice game, short-term game on this, but it's come down to levels and pulled back to where I think it's a scream and buy again. This is an industry that everyone suddenly loves. Everyone hated this industry forever. If I tried to promote this industry, I'd get maybe one person to subscribe. Everybody loves it now. And they're going to love it for a while because the fundamentals of this industry have never been stronger. It's one of the areas that are going to see incredible growth in a market where most companies, the S&P 500, has not seen growth in 3 straight quarters and likely not to see growth this quarter, which will make it 4 straight quarters. Dan and I tape Wall Street Unplugged Premium every Thursday, so we share individual ideas and really break them down, actionable advice. And these names go into our portfolio called Dollar Stock Club, which is a trading newsletter. Recommend a stock every single week, usually based on what we're seeing in the market and the news and stuff like that. So you see the most disconnects, especially during earnings season, which we're in right now. But we charge $10 a month. Amazing value for what you get. You can cancel anytime. So you get subscription to the newsletter and this special premium podcast, which is about an hour long. And we also break down that stock. And Daniel also does a video portfolio update every 2 weeks. So we've gotten some amazing feedback from you, putting that behind the paywall. This podcast is totally uncensored too, so we don't hold back and tell the truth no matter who we offend, all in an effort to make money for all of our listeners. So if you're interested in learning more about Wall Street Unplugged Premium, go to www.curzonresearch.com. Guys, that's it for me. And me and Daniel, we'll see you tomorrow. Take care.